the debits and the credits. And so what we spent a lot of time focusing on here is that our debits only mean left and credits only mean right. Now, depending on what kind of account we're dealing with, a debit will increase assets, and that's the normal balance for assets, where a credit will decrease the asset account. But for liabilities and stockholders' equity, a credit increases the liabilities and stockholders' equity accounts, and a debit decreases liabilities and stockholders' equity. So then we looked a little more about expanding this to know that assets equal our liabilities plus our stockholders' equity. And stockholders' equity consists of the common stock, which are investors coming in from outside the company, and then retained earnings are those claims that come from within the company through net income. So retained earnings gets increased every time we finish out a month or finish out a year by taking our net income and increasing that into our retained earnings. So our revenues and our expenses, those are the accounts that ultimately create net income, right? So revenues increase our retained earnings, expenses decrease our retained earnings. Dividends ultimately also decrease our retained earnings because we're paying a share of the profits back to the shareholders. So this we focused on. It's a great thing to memorize. Dealer, just know dividends, expenses, and assets always have a debit balance, whereas liabilities, owner's equity, and revenues will always have a normal credit balance. This is just a good cheat, a card to keep with you. There are 6 kinds of accounts. There's assets. Assets we know have long-term benefits. Liabilities, monies we owe. Owner's equity, the owner's claim to those assets in a business. Revenues are part of the income statement. Monies, the reason the business is alive, the reason the company is there to bring in revenues. Expenses are the cost to bring in those revenues. And then dividends are giving a piece of the profits back to the shareholders. What does the word debit mean?
Left side.
I'm so glad. I might trick you and for sure put that on your midterm. Wouldn't you like that? And if you get that wrong, you get the whole midterm wrong. So now this starts to become the crux of this chapter. We're going to now record transactions in a journal using debits and credits. A journal is what provides a chronological record of all the transactions. And this journal entry is what we're going to use. It's the format we use for recording transactions. The format will have a date. It will have an account name and a debit amount. The debit always goes first. Then, for the account name that gets credited, we will always indent that account name. and put the amount on the credit side with the description. In the end, every single transaction, the amount we post as debits will always equal the amount we post as credits. So let's take our good old golf school again, and let's look at this. Now we've gone through these same concepts. Now we're just talking about it in a little different fashion. It's the same concept though. On December 1st, Eagle Golf Academy sells shares of common stock to investors for cash of $25,000. So guys, what's happening here? We issued common stock. So two accounts that are affected, cash goes up and common stock goes up. So cash is what kind of account? Asset. When cash or an asset goes up, what do? We debit it. So do you see in our journal entry here? We show the name of the account, cash. We know it's an asset. We're going to debit it $25,000, which means it's increasing. Now what happens to common stock, guys? It increases. What's the normal balance of stockholders' equity? A credit. So do you see, if we debit cash, that goes up $25,000. We debit it. Common stock goes up $25,000. We credit it. Do we balance? Yes, dear.
So I'm trying to word my question, like understandably. So the people who own the common stock, it's not us though. So why is it written as if like we own it? Because if they own it, aren't we losing common stock?
Okay.
But instead it's credit, that means it's increasing.
So basically, let's say this company, Eagle Golf Academy, has an owner. But in a perfect world, it would be great to have all the money on your own so you don't need to get investors. In a perfect world, keep all the profits to yourself. But you know the biggest problem with companies, the reason they can't grow is we need money. How do you get money? You can borrow it, but who's going to lend you a brand new business the money you need? It's impossible. I mean, it's not impossible. It's highly unlikely unless you have some type of huge resource. So, if you have shares of stock and decide, okay, I'm going to let people become a part of this company and own a piece of this company. So I'm going to issue them a share of stock in exchange for they're going to give me cash. Okay? So this company just isn't owned by Eagle Eye. It's owned by the investors. Okay? So, again, from the company's standpoint, the company's receiving stock or cash and in turn issuing stock. Those individuals own the company. Does that make sense?
Yeah.
They own what? The money's staying in the company. And in turn, those investors received a piece of stock. So, I'm sorry. So moving on. Many students forget to indent the credit account names. For the account credited, be sure to indent both the account name and the amount. So we are going to take each journal entry and learn how we then post it to the various general ledger accounts.
Did you turn your mic back on?
What?
Did you turn your mic back on?
Posting is the process of transferring the debit and credit information from the journal to individual accounts in the general ledger. The general ledger is a book or is like a it's oftentimes software, but it's a place that provides a single location, the list of transactions affecting each account and the account's balance. In this general ledger, you're going to see the account name or the account title, the transaction date, the transaction description, columns for debits, credits, and a cumulative account balance. So we're going to go through our Eagle Golf Academy and see how this works. And then we're going to do a lot of problems on our own. On December 1st, Eagle Golf Academy sells shares of common stock to investors for cash of $25,000. So guys, we know cash gets increased and common stock gets increased. Now cash is an account. We know it's an asset, but it's an account and it has its own separate title. So we're going to go to the general ledger where we see the account called cash. It started with a zero balance because remember the company started with nothing. But cash was debited $25,000. To post a transaction to the various accounts means we literally take this account, we show the date, we show the description, issue common stock, we take this debit and we transfer it here to our cash. Since cash is an asset, we know it has a normal debit balance, so we're going to carry it over here. We're also going to do the same thing to common stock. Common stock is a stockholder's equity. It has a normal credit balance. So in the same respect that we showed the first journal entry, or the first part of the entry, we debited cash, here we're going to go to common stock, credit this $25,000 here. This is what we call by posting. Here, let me go back here. Okay? Now the next is the next transaction was we borrowed cash from the bank for $10,000. So the journal entry to record that borrowing cash from the bank is we increased our cash by $10,000 by debiting it. We increased our notes payable by crediting it. Let's post this transaction. We're going to go to the account that says cash again. We're going to show December 1st borrowed cash by signing a note for $10,000. Now we have a balance of $35,000. We're going to post this transaction to the note payable account. Notes payable, a credit of $10,000. Do you see we started with a zero balance? On December 1st, we borrowed cash, credited $10,000. We have an ending balance here of $10,000. Does that make sense, guys? Next. On December 1st, Eagle purchases equipment with cash. Debit cash of $24,000. Debit equipment of $24,000. We credit cash of $24,000. So now they're introducing what's called a T account to us. It's basically an easier way for us to show the balances, the debits and credits in an account. So the T account, what we call, is a simplified version of the general ledger account. And it includes the account title at the top, the left side for recording debits, and the right side for recording credits. So you see equipment here. We're going to take our debit, post it to the debit side of the equipment account. The cash, we credit it. So we show transaction 3, a credit for $24,000. Okay? Prepaid rent. On December 1st, Eagle pays 1 year of rent in advance, $6,000. $500 per month. What happens? Our asset called prepaid rent increases, and our credit of cash decreases $6,000. Okay? If you look here, do you see how our prepaid rent, we showed transaction 4, a debit here of 6, cash, a credit of 6, we put it over here. You see how we're just posting these various transactions to the accounts they belong to. Next, we've got Eagle purchases supplies on account, $2,300. Our supplies, which is an asset, increases. Our accounts payable, which is a liability, increases. You see number 5, we debited supplies. Accounts payable, we credited accounts payable. Make sense? Next, on December 12th, Eagle provides golf training to customers for cash, $4,300. Cash increased $4,300. Service revenue increased $4,300. Do you see number 6, debit to cash, service revenue, credit. Then on December 17th, Eagle provides golf training to customers on account, $2,000. Our accounts receivable increased, $2,000. Our service revenue increased as a credit, $2,000. On December 23rd, Eagle receives cash in advance for 12 golf training sessions to be given in the future, $600. That means we haven't provided it yet. We've got the cash, but we haven't done the work, right? So cash increases, which is an asset, but our deferred revenue, which is a liability, increases, doesn't it? $600. Do you see here the account cash shows a debit here? Our deferred revenue, which is a liability, shows a credit. Next, on December 28th, Eagle pays salaries to employees, $2,800. Do you see our salaries expense gets debited? Our cash gets credited. Over here, salaries expense is a debit of $2,800. Cash is a credit of $2,800. Make sense?
I have a question. On the cash, it says the balance is $7,100. How did they get that equation?
Okay. So after this $2,800, if we total our debits, total our credits,
Okay, so then it should equal out then. Okay.
it will balance to be a debit. Because
Okay.
remember, cash will always have a normal debit balance.
Right, so then they just do this ahead of time and just plug it
So
in.
25 plus 10 is 35, plus 43 is 39.3, 39.6, minus 32.8,
Okay.
right? 39.6, 32.8, 71.
Okay.
What? I was wrong.
It's 39.9.
Oh, I'm never wrong. You're right. 39.9, a 300 and a 600. I'm sorry, guys. Does that make sense, though?
Yeah.
Okay. On December 28th, no, you got to give me a hard time. On December 28th, Eagle pays cash dividends to shareholders, $2,200. We debit dividends for $200, and we credit cash for $200. Okay? So here's a summary of our transactions, and here is a listing of all of our T accounts. Do you see? We put all of our assets together. Our cash, accounts receivable, supplies, prepaid rent and equipment, all our assets. Our liabilities are all together. Our stockholders' equity up there, common stock and retained earning, are the two accounts for stockholders' equity. And we know ultimately the service revenue and salaries expense will net out to go up into retained earnings, won't it? along with our dividends. So that's why they show them below for now. Which of the following is used to provide a chronological record of all transactions affecting a firm? What?
The journal.
Perfect. The journal. Which of the following accounts would be debited when a company pays $12,000 in advance for 1 year of rent? Good. So let's go and look at some problems. 214, page 91. So, exercise 214, do you guys have it?
I don't think so.
No, we have 215.
Are you sure you don't?
12
Yeah,
and
pretty sure.
216.
I mean, we can just like read our books, write stuff down though.
Otherwise we have
Like, to
211
make
too.
progress.
Well, we've got plenty to pick from. Well, darn it. Okay, we're going to move on to 215. How about that? We've got plenty. So, 215. Consider the recorded transactions below. We're going to post each transaction to T accounts and compute the ending balance of each account. So the beginning balance of each account before the transactions is cash is $3,400. So did I leave the account names on the T accounts or did I take everything off? Everything's on it. So what you want to do is for 215, there's a balance in cash of $3,400 before we began. Do you see that? So you need to look down here. Required. Exercise 215. Post each transaction to T accounts and compute the ending balance of each account. The beginning balance for each account before the transactions. So we want to do this first. So the beginning balance of cash is $3,400. Are we going to put that on the debit side or on the credit side? Why? It's an asset. So you're going to begin, you're going to write the word balance, even though this doesn't show balance. But you see here the $3,400, this is what we began the balance, the account with, okay? You're going to put a $3,400 in there. Then it tells us accounts receivable should have a balance of $4,200. What are you going to do there? A debit of $4,200. What about supplies? What is that? An asset, debit of $400. Accounts payable, a liability, a credit balance. Deferred revenue is what? A liability, credit. Service revenue, what is that? A revenue account, credit. Advertising expense, an expense account, which is a debit. So we start with putting in those balances, okay? Are we good? What kind of account is deferred revenue? It's a liability, so it's a credit. Okay? And I'm not trying to be rude, I'm just trying to help you think. Okay? Since deferred revenue is a liability, and liabilities have normal credit balances, we're going to put a credit in there, aren't we? Okay? So now consider these transactions. Post each to the T accounts and compute the ending balance of each account. So guys, let's just look at number 1. Accounts receivable is a debit of $8,400. Service revenue is a credit of $8,400. What do you think? Why would we record that entry? Could it be we provided services on account? Does that make sense? Why we would debit accounts receivable and credit revenue. Make sense? So I want you to now go to your T accounts and right next at accounts receivable, you see where this account is? Put a 1 here. Put a debit on accounts receivable here. See there? And then we're going to go down to service revenue. And do you see I have a 1 here? Put a credit amount in service revenue. We're posting that journal entry to the account. The accounts it relates to. Accounts receivable gets debited for this transaction. Service revenue gets credited. Got it? Make sure you put a 1 because that helps identify why you put that number there. Next, number 2, supplies is a debit of $2,300. Accounts payable is a credit of $2,300. What do you think happened here, guys? Did I leave my keys in my office? So, what do you think happens there, guys? We purchase supplies on account. So, we're going to go and show number 2, supplies gets debited here. And do you see how our accounts payable here gets credited for $2,300? Make sense? Supplies gets debited, accounts payable gets credited, $2,300.
Okay, so if it ends up in money in the credit form for accounts payable, are we gonna have to pay that?
Okay, say that again.
It's usually credit.
It's usually a credit. Accounts payable is a credit.
What happens with the $2,100 in credit? Or is that just
So just hang in there with me, okay? Let's just do this. I think you're thinking ahead. You're thinking ahead, which is good. Hang in there. So the next one, number 3. A debit to cash for $10,200, a credit to accounts receivable for $10,200. What do you think happened here?
Someone paid us in advance.
Someone not paid us in advance. They paid us what they owed us. So cash increased, but our accounts receivable went down, didn't it?
Yeah.
So the reason the accounts receivable went down is they gave us the money they owed us. Got it?
This is the easier question of what I was trying to ask.
Yes.
Accounts receivable, if it ends in a debit balance, are we gonna receive $2,400 or are we supposed to see
Our plan is to see $2,400.
in the debit?
The debit of accounts receivable means we have $2,400 worth of money that's due us.
Let's do it.
That's due us. The accounts payable with a credit of $2,100 means we owe $2,100.
Okay. Sorry, bounce back real quick. You said credit of accounts payable means we owe?
Credit Since accounts payable is a liability, the purpose of a liability shows who we owe money to. So once we go through these transactions, we're going to come up with ending balances. And an ending balance on an accounts payable means that's how much we still owe to people. Accounts payable is a liability, which means we owe money. Accounts receivable is an asset, which means we are to receive that money.
So if we ever would end in a debit for accounts payable, we already paid?
If we end in a debit, something's wrong. That means we paid too much. Okay, it's kind of like your bank account should have a normal debit balance. That means we have cash in the account. There are times our account goes to minus numbers. Do we want minus? Not a pretty sign.
Okay, so I think I got it. So back to accounts receivable, if we end that in a credit, that's wrong too?
That means someone's paid us too much.
Okay, so okay,
Again, the concept of this, when we say has a normal debit balance, it means that's what it should be. If it's not, something's wrong. I'm not saying it couldn't happen, but it means somehow we got, if accounts receivable has a credit balance, it means we either posted something incorrectly or someone gave us too much money, we owe it back. Make sense? No, so number 3, we're going to show the cash of $10,200 and credit our accounts receivable of $10,200. So again, up here, cash, number 3, $10,200, and then our accounts receivable is a credit of $10,200. You see that? Next, number 4, advertising expense is a debit of $1,000, a credit of cash for $1,000. We're going to go and we're going to post that. Do you see number 4, a credit of cash here, $1,000? And we're going to go down to advertising expense, a debit, number 4, $1,000. Make sense? Next, number 5. Why would we have a debit to accounts payable and a credit to cash? We owed money and we're paying it back, right? We owe somebody on account, we're paying them. So look what's going to happen here. Our accounts payable gets debited, guys. When our accounts payable gets debited for $3,700, we were originally having amounts we owed people $5,800. Now that we paid $3,700, now we only owe people $2,100. Do you see how it went down? Yes? And our cash was credited for $3,700. Okay? Next. Number 6, we debit cash, we credit deferred revenue for $1,100. Why would we have done that? We received money in advance for services we have not yet performed. So, do you see our cash gets debited for $1,100 and our services revenue, deferred revenue gets credited for $1,100.
Here's a question.
Yes.
I got confused on the homework when I was reading about unearned revenue and deferred revenue.
Same thing.
Same thing?
Right now, same thing. Okay. So we need to post each of these and compute the ending balances of each account. So you're going to total your debits, total your credits, and you should end up with the cash should have a balance of $10,000. Again, remember, it's a normal debit account, so we hope it's got a balance that's a debit. Accounts receivable, we total our debits, total our credits, we should end up with $2,400 debit. Okay? Supplies, we should have a debit of $2,700. Accounts payable, what should our balance be, guys?
And would you put a negative sign before the 2,100?
No.
How would that be shown?
That was another thing.
All we do is put it on the credit side.
Oh, it's not.
Because it's not a negative number. It's just a credit balance. It's a balance. It's not negative. It's just on the right-hand side.
Okay, I got you.
Yes.
So none of these are supposed to be negative.
No.
It's just
They're left or right.
starting.
No negatives, just left or right. Then our deferred revenue, we have a credit balance of $1,400. Our service revenue, a credit balance of $8,400. Advertising expense, a debit balance of $1,000. Does that make sense, guys?
Yeah.
Okay, let's go to the next one. Now, this one says, we're going to kind of do the opposite. We have some T accounts that have numbers next to various account numbers. So, for example, number 1, do you see a cash? Number 1 has a debit of $20,000. And then if we find the other number 1, do you see service revenue, a credit of $20,000? You see that? We have to provide an explanation for each transaction.
Is that 216? We don't have that.
We don't have that.
We have 216.
You
It's
have it on the
in-
side, don't
yeah,
you?
on this page with the.
It's okay. I was trying to make it fit. So guys, the first one, a debit to cash for $20,000, a credit to service revenue for $20,000. What the heck's going on here? Provided services for cash. Perfect. Does everyone understand why, how we could communicate that? Number 2, I see a credit for service revenue of $5,000, and then I see a debit accounts receivable $5,000. What would that be, guys? Provided services on account. Does that make sense? You see how it's important to be able to look at these accounts and figure out what happened? Look where you guys are coming from. You see how you're able to start making sense of how we are communicating this information? Number 3, a debit to cash for $3,000 and, a debit to cash for $4,000 and a credit to accounts receivable for $4,000. What the heck happened here? Someone paid us. We received cash. As a result, we decreased our receivables. They don't owe us that money anymore, do they? Make sense, guys? Number 4, I see a debit to supplies of $6,000 a credit to accounts payable for $6,000. What happened? Bought supplies on account. Number 5, a debit to salaries expense for $14,000. A credit to cash for $14,000. Paid salaries. Number 6, a credit to cash of $7,000 and a debit to accounts payable of $7,000. Paid down some bills we owed, didn't we? Okay? That's it, right? So basically, guys, what you're doing is you're gaining an understanding of these transactions and probably what happened. Does that make sense? Okay. I think what we're going to do is take a 5-minute break, and then when we